Ladies and gentlemen, there is an urgent matter at hand, one that affects not only seasoned investors but also those who are just beginning to dip their toes into the world of finance. The bond market, specifically the TLT ETF, is in a state of flux that demands our immediate attention. This is not just a concern for those who have already invested but for anyone considering it. In the following discussion, we will unravel the intricacies of the bond market, its implications, and the actions you can take to protect yourself from potential harm. The TLT ETF, which represents 20-plus-year treasuries, has seen a massive influx of capital in 2023, despite the fact that it's down over 40% year-to-date. Investors have poured billions of dollars into it, making it the third most popular ETF in terms of flows. Even in a single month, July, it recorded more than $4.7 billion of new investments, its best month since its launch in 2002. It's evident that investors are still keen on the bond market. The TLT's poor performance might raise eyebrows, but it's essential to understand the dynamics at play. Long-term bonds, like those represented by TLT, are more sensitive to changes in interest rates than their shorter-term counterparts, making them inherently more volatile. The current SEC yield on the TLT fund is 4.9%, significantly higher than what it offered a year ago. This tells us that investors are drawn to the potential yield, but it also reveals the uncertainty surrounding the bond market. Investors flock to long-term bonds even in the face of falling prices because they seek long-term yields, and the supply of bonds is currently outstripping demand, pushing prices down and yields higher. The bond market's performance is not simply driven by the bond's yields, but also by the impact of changing interest rates. The bond market's behavior is somewhat perplexing, as it defies traditional investment logic. TLT and similar bonds are attractive due to their asymmetrical returns. A 300 basis point increase in yields leads to a 24% decline in bond prices, while a 300 basis point decrease results in a 52% increase in bond prices. This asymmetric risk-reward profile has led traders to make contrarian bets on the bond market. However, there's more to the story than meets the eye. The concept of opportunity cost plays a significant role here. Holding onto a 5.4% one-year Treasury bill offers a different opportunity than investing in long-dated bond ETFs. One might be tempted by the potential gains from a bond rally, but the opportunity cost of not investing in other instruments cannot be ignored. The bond market's future is uncertain, and the timing of its movements is unpredictable. The 20-year yield can continue to rise, potentially reaching 6% or even higher, leading to further declines in TLT and similar bond investments. The bond market's trajectory will depend on various factors, including economic conditions, inflation, and government policies. As an investor, it's crucial to remain cautious and prepared for the unexpected. While there may be opportunities in the bond market, there are also substantial risks. The yields on long-term bonds can have far-reaching consequences for both the equity and bond markets. In a world where the 10-year or 30-year Treasury yields hit 7% or 8%, it would be unprecedented, attracting immense capital and impacting various asset classes. So, what should you do in the face of this uncertainty? Diversification and risk management are your best allies. Building a balanced portfolio that can weather market turbulence is key. Consider your investment goals, risk tolerance, and time horizon, and consult with financial experts to tailor a strategy that suits your needs. Stay informed about macroeconomic data, geopolitical events, and central bank actions. These factors have a significant influence on the bond market's movements. Monitoring key indicators and signals can help you make informed investment decisions. The bond market is not a one-size-fits-all scenario. Your investment choices should align with your financial objectives and your appetite for risk. Seek professional advice and guidance when needed, especially in a market as complex as bonds. The expertise of financial advisors can help you navigate the nuances of bond investing. In conclusion, the bond market's current situation is complex and uncertain. While there are opportunities, there are also substantial risks. Timing the market is challenging, and it's essential to be cautious, prepared for the unexpected, and seek professional guidance when necessary. The world of bonds is intricate, and your investment decisions should be made with careful consideration of your unique financial circumstances.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.